Good afternoon, everyone, and welcome to Stowe & Deagon's latest episode of our webinar series. I'm Marty Coyle, a partner at Stowe & Deagon, and I'm happy to be here to introduce the program. Today, we're going to talk about a very important and timely topic, ASC 842, all about the new lease accounting rules. Today, we're going to do an overview of it from 40,000 feet. And in another 30 days or so, at a date to be determined, we will do part two, which will be a deeper dive into this topic. Our speakers today will be colleagues from our audit team, Keith Erickson and John Ridden. And before we introduce them, I'd like to go over a couple of webinar attendance guide. Can you advance the slide, please? Three things. Today, we welcome all questions. Please type them in the Q&A box. We will not be taking live questions. At the end of the comments from Keith and John, we will answer as many questions as we can get to. And if we don't get to them today, we will get back to you if we know who sent the question to us. Secondly, the presentation is being recorded. So if you have a desire to watch it again or have a colleague watch it, it will be available to watch at a later date. And finally, we ask that you take our short survey. This is how we determine how we're doing and whether or not we're delivering good content, the best content we can to you. We can't talk about everything that's important in 842 today. So if you have questions, we're going to just touch on the high strokes of it today. And if you have questions, please reach out and contact your colleagues at Stowe & Deagon that you know. So over the next 35 to 40 minutes, Keith and John are going to overview the key points of this new ASC. And when they're done, I'll come back on and I will address all of the questions that are put in the Q&A. So let me introduce our first speaker, Keith Erickson. Thanks, Keith.
Thank you, Marty. I'm Keith Erickson. I'm an audit partner with Stowe & Deagon. I specialize in audits, financial reporting, especially complex financial reporting issues and new pronouncements, and also our SEC and internal control areas of the consulting practice. I've been with Stowe & Deagon since 2004, and I, in some way, shape, or form, have some level of responsibility in reviewing almost every financial statement that goes out that's been audited. We're going to discuss, why this new pronouncement is important to you, what the standard scope is, what is changing, how to make the calculations to do the initial measurement. We're going to show you what it's going to look like on your balance sheets, and then we'll summarize. Next slide, please. This new pronouncement, it's been delayed several times, and finally it's going to come to fruition for everybody. It's been a requirement for public companies since the end of 2018, and for non-public companies, it takes effect for years beginning after December 16th, 2021. So for most of you, that's going to be January 1, 2022. And if you have a fiscal year that starts after that, then that's the year that it'll begin to take effect for you. But it's good to plan ahead. It's going to have, there's some complex calculations that have to be done. You're going to want to analyze your existing leases. And if you're considering entering any new leases, you may want to consider all the factors that go in, because it may affect how you structure those leases. We've been dealing with this since 2018 ourselves as a PCAOB registered firm. We audit several public companies, and they had to implement it, like I said, 3 years in advance. The new standard is going to create a pretty significant change to balance sheets of all entities that have long-term leases. It won't have an impact on leases, rental agreements that are typically less than 1 year, although we will expand on that, because if the intent is to continue leasing your assets and you really have no other means to continue in business, they're not really creating a loophole for you to do a long series of 1 year leases. But there's a lot of analysis that would have to go into that decision to see, if you're able to exclude any of your leases from that calculation. Another important factor that we really want to highlight, and this is why it's important for you to try and address this situation as early as you can, it's because it's going to affect your balance sheet. It's going to affect current assets. It could affect long-term assets. It can affect current liabilities and long-term liabilities. Depending on your bank lending situation and debt covenants that you may have concerning current ratios and other ratios, that are all these balance sheet subtotals affect, you may want to try and at least estimate now, and you can calculate now what the effect will be on your balance sheet, and recalculate your debt covenants and see if it throws you into an unintended and a non-compliant situation, because you may want to start negotiating some sort of amendment with your bank sooner rather than later. And the reason that we're bringing this to your attention, now and not when we start planning our audits and late in the year, is because we think it's important for everybody to have the time to address it and try and get ahead of it. And the bankers don't want any surprises, and I know the business owners don't want any surprises either. So next slide, please. So this standard, it applies to substantially all leases and subleases of real estate and tangible property. Like I said, there's a scope exception for short-term leases and rental agreements that are 1 year or less. Typically that's going to apply to smaller agreements and those that are truly temporary. And you can separate non-lease components. There's an election. Well, again, we're not going to get into all the nuts and bolts of the calculations, but there are some elections you can make depending on how the terms of the lease are structured and what costs go into your lease payments and that sort of thing. So most of our clients have leases that are fairly straightforward and are strictly a lease agreement. This pronouncement gets fairly complicated if you have an agreement that has a lot of components and only one or some of those components are actually a lease. If you feel as though you have some contracts that may involve a lease, it's going to be important to have an expert look at those and make sure that the different components of that agreement are accounted for, and especially the lease components are accounted for appropriately within this standard. Next slide, please. So what is changing? Upon adoption, the lessees are going to recognize typically an asset on their balance sheets, and it's going to have to be a separate line item effectively. You can't just group it in in a subtotal with fixed assets. It needs to be disclosed. And basically, that asset is the fair value calculated of the lessee's right to use the particular leased asset in question. So it could be buildings, it could be land, it could be equipment. And basically, there's a calculation and there's inputs that have to be determined within that calculation to determine the fair value of the liability and the fair value of the asset. So currently, if you have only operating leases, then there are no lease assets on your balance sheets. And so this is where that change is going to take effect. And this is where, you're going to want to see once you do these calculations, how it's going to affect your bank covenants, because you may have, assets in different and liabilities in different categories and captions on the balance sheet. The lease liability calculation is basically for all leases that aren't otherwise excluded from the scope. Again, short-term leases, if there's leases for smaller office equipment and even potentially automobiles that are relatively small, depending on the size of your business and what you and your auditors and financial advisors consider material, you may be able to scope those out as immaterial. But you basically want to try and categorize all similar leases as one category and address it at that level. Another thing that's going to be a little bit more rigorous is the disclosure in your footnotes. I mean, currently, right now, typically, you have the total lease term, the remaining payments, the lease payment amount. You're going to have to discuss, how you determine what category of lease you have now. You're going to have to discuss the inputs that go into the calculation, which will be, gone over in much greater detail on our next webinar when we get into the real fun stuff of all the nuts and bolts of the calculations that are required. And so, again, a lot more detail is going to go into the footnote. So there's going to be more time for involved with management trying to analyze the parts of the lease, the wording in the lease that needs to be disclosed, and obviously the auditors have to address that as well and ensure that the disclosures meet the requirements of the new standard. Again, I'll note that the exemption for leases of less than 12 months, and like I said, for smaller leases that are immaterial, it doesn't need to be applied. Next slide, please. So now I'm going to hand it over to John Reardon. John will introduce himself and kind of go into some of the details as to what is going to take place when you get started in this process.
Thanks, Keith. Good afternoon, everyone. I'm John Reardon. I'm a senior manager at Stowe & Degon. Been with the firm about 6 years now. The measurement of the new lease liability, well, the measurement of the leases starts with the liability. The liability that you're going to record on your books is going to be the present value of the minimum rental payments expected plus any guaranteed based on a discount rate determined the later date of the date of initial application or commencement of the date. And that date of initial application, what we mean by that, what is known at that time. If you happen to know what the implicit rate is in the lease, that's the rate you should use and determine the lease liability. Otherwise, you should use the incremental rate of borrowing for a similar type asset. If you have a 30-year building that you're leasing, it's going to be a different rate than you might come up with if you're leasing, a 5-year automobile lease or a 7-year heavy equipment lease. So the rate that you use should be reflective of the type of asset that you are leasing. That forms the basis of the asset. Starting from the minimum value of the lease liability, you would include any prepaid rent. Most often, leases are due at the beginning of the month, so chances are, your remaining lease payments are going to exclude that first payment because you've already made it. But you need to add in that prepayment. So if you had a 60-month lease, you made the first payment already, and you got 59 to go. The minimum value of the present value plus the first payment, minus any accrued rent. For anybody out there that was, had discounted or escalating rent payments, and you have a deferred rent liability on your books for escalating rent payments that have been using to straight line the rent, that gets rolled into the right of use asset, plus any unamortized initial direct costs. There is a practical expedient you can elect to not evaluate that, but that unamortized initial direct costs under the new standard, the amount of costs that are allowed to be deferred is more restrictive than under previous guidance. It's limited pretty much to anything that is just but for this would not have been incurred. So it kind of limits you to any kind of commission you would have paid or any kind of payment you may have made to a previous lessee to vacate or break the lease so you could occupy the space. Minus any unamortized lease incentive incomes. If you were given some sort of incentive at some point in the past, and now all of a sudden, you need to roll off any unamortized balance into this new right of use asset. Impairment, if for any reason the asset you are currently leasing is impaired for any reason, you're carrying a liability, that will be rolled into the right of use asset. You recognize the right of use asset as of liability as of the later of the date of application or lease commencement date. Under the standard, there are 2 dates of implementation. You can implement it on 1/1/2022, or if you wanted to, you could do a modified retrospective implementation and, implement it as of, if you're presenting 2 years financial statements as of 1/1/21. In that particular case, if you entered a lease in the middle of one of those periods, that would be your lease commencement date. If you entered it prior to that date, it would be the date of adoption. Next slide, please. Here's a look at the balance sheets that might look today for your typical small companies. You can see current assets of 4.5 million, next fixed assets of 2.5 million. And you can see right under there in the lease fixed assets, the items under capital lease. Okay. Total on the left side, on the right side of the balance sheet, you can see your current liabilities. You have your capital lease component broken out into its non-current portion, $200, and its current portion, $800. Okay. Next slide, please. Here's what it looks like under the new standard. You can see the existing on the left, and on the new standard, you can see the capital lease now becomes a finance lease right of asset. And then under the bottom, you're going to have your operating lease right of asset. This is important, that financing leases, which are akin to the old capital lease, and operating leases, which are primarily real estate leases, cannot be commingled. And they need to be disclosed separately, either on the face of the financial statements or in the notes thereto. So you may have, for all entities out there, you're going to have another asset category, operating lease right of asset. Next slide, please. And here's the right side of the balance sheet, the liabilities and equity. You can see, as it was before, you have your capital lease current and non-current. And on the right side now, you're going to have finance lease obligation current still there. And then you're going to have a new operating lease current obligation. The lease obligations, both capital, finance, and operating, need to be broken out into their current and long-term portions. And there are a few ways that you can do that. They're a little bit detailed, but there are some options as to how you determine what you're going to put in the current or long-term values. Next slide, please. Keith, I think it goes back to you.
Yep. So, like I said earlier, Stowe and Degon as a firm has been dealing with this for a good 3 years now with our SEC registrants, and so we've got tools already to assist. For our audit clients, we're limited by independence rules as to exactly how much we can do, but we've got plenty of tools to assist you and walk you through the process, and we're more than happy to walk any company's accounting staff through the process of data gathering and applying the data to the templates and making sure that the calculations come out. We're a PCAOB registered firm. We work with SEC registrants both as their auditors and as consultants. The impact, the example we gave was one. We're showing $1 million, depending on the length and the term of your leases. When you look at your current footnote, there's an amount of lease payments that are basically guaranteed that are spelled out. So while the amount of the net present value will be lower, I mean, that's a ballpark figure as to what it's going to look like on your balance sheet. If you take the total of your remaining payments and you've got some long-term leases that show payments over $1 million, then the impact to your balance sheet may be very close to $1 million, depending on your current borrowing rates. So it's typically for good-sized companies that have a good-sized real estate lease or significant machinery leases, the impact can be pretty significant. We just want to make sure that everybody's well aware that it's something to really get out ahead of. Next slide, please. So just to summarize what we've gone over, the new rules take effect for years beginning after December 16, 2021. If your year ends between now and then you've got almost a whole nother year to implement it. But if your year ends on the calendar year end, then January 1, 2022 is when it begins. If you don't issue interim statements, you do have some time before you'll be actually presenting it in your financial statements, because if you only present it at the end of the year, that's when it'll actually show up. But you're not going to want to wait and show your banker a year later that, geez, you know what? These new rules caused me to not be in compliance. And then there's a scramble to get your audit done, your financial statements issued, and it's a surprise that's unwelcome by everybody. These rules will affect, all entities with operating leases and financing leases. The difference is much more significant on the operating leases. Currently it's only a footnote disclosure, and now there's a lot more work involved. So we thank the FASB for making these projects for us so that we can continue to stay in business and collect our audit fees. But on the other hand, it's a lot more work for everybody involved, and it's a headache. And for smaller companies with smaller accounting departments, the work can be very, very trying and complex, and you may not have access to all the tools we have for doing our research and setting up the calculations. So we're here to help. We don't want you to get in trouble with your bank. I can't. I'm not going to go into all the different disclosure items that are in there, but I've got 10 different bullet points that I pulled out of the FASB document, are basically additional disclosures in the footnotes that have to be derived from your lease agreement. So there's going to be some analysis work there, and we want to help you and share the tools we have, and hope you'll take advantage of it. Next slide, please. So we got through this relatively quickly. Like we said, it was going to be a pretty high level overview. I'm sure you'll have a lot of questions, if not now, over the course of time. And we're hoping that we can answer some of those questions now. And I think you'll find the next version of the webinar, where we really get into the nuts and bolts of it, very enlightening as to the level of effort involved in applying this standard. It's difficult to, narrow it down to a set amount of time, but depending on the number of leases you have, it's going to be several hours per lease to analyze all the terms and make sure that you've identified all the components that have to go into the calculation of net present value, as well as what has to go into the footnote disclosure. So with that, I'm going to open it up to the questions.
Thanks, Keith. I've got a couple here that I see. The first one is I own a manufacturing company 100%, and we have a long-term lease with an entity that I also own 100%. Since it's a long-term lease, I gather that I have to follow these new rules of ASC 842. Is it possible for me to avoid all these headaches by rewriting the lease and making them one-year leases, since it's just me, myself, and I?
All right, I'm going to jump on that one because John gets all the really hard ones. So whoever asked that question, thank you very much. That's a good question. There are a couple of variables. If the entity that owns the property is not consolidated, the rules are different than if it is consolidated. If it's consolidated entities, this really wouldn't apply. But with that being said, since you control both entities and the intent is to remain, if the intent is to remain in the facility and you really don't have any other options, that's not really a loophole that you can exploit. They really want to have this calculation based on what the expectations are. It's substance over form. And so typically that would not be an option. If you're in a situation perhaps where you're considering selling assets, selling the business, if you're doing it for a valid business reason, because maybe you're looking for an exit, there may be some consideration there, but obviously that would have to be analyzed. But typically I would say the answer to that question is no, you can't just restructure those leases.
Well, that's too bad. Here's another one. What is included generally when you're talking about minimum lease payments?
Generally, it's speaking, it would include all of the payments that are contractually mandated during the term, plus a bargain purchase option if it was, expected or assumed that, expected to be exercised, or an option to renew if those are expected to be exercised, plus any termination penalty if it is expected that you will terminate the lease early. What would not be typically included are things that used to be called executory costs that are now what we consider non-lease components, things that do not transfer any kind of benefit to the lessee. Real estate taxes and insurance being the two most prevalent ones. Those are generally not considered part of the lease because they only protect the lessor's interest. So those are treated, even if they're paid directly by the lessee, those are generally not included in the minimum lease payments.
Also, part of this question is I'm not sure I know how to figure out how to do a present value calculation and figure out which interest rate that you were mentioning. Can someone at Stowe and Degon help my team get through that process?
Yes, we certainly can. We'll look at your current marginal borrowing rates and look at similar financial instruments and things like that, and come up with a rate that's reasonable, depending on the circumstances. If you've got already a line of credit, or if you've already got some other borrowing for assets aside from leases, then we can incorporate averages of those rates and determine what a reasonable discount rate is.
Okay. Here's
John,
another
I'm counting
question.
on you to correct me if I make any mistakes.
You're doing great. Here's one. What's the criteria for current versus non-current?
The current is the same for leases as it is for debt. So it's the payments due in the upcoming 12 months.
Okay, so non-current would be beyond.
Non-current, yeah, any payments, accumulation of payments beyond 12 months from the balance sheet date.
Is the operating lease at present value?
Yeah,
Yes.
basically that's the change. In the past, the operating leases were just basically expensed as incurred. Obviously, there were some nuances there. If they weren't straight line rent payments, it was expected you'd straight line them. But now you have to calculate the net present value of your operating lease payments, assuming they're material. And that's how you calculate the liability and the value of the right of using the asset that you're leasing.
Okay. Here's one. Does this pronouncement affect lessors or at all, or is it only applicable to the lessees?
Keith, you want me to take that one?
Yeah, go ahead,
Sure.
John.
Yeah, for
I
the
wanna be
most
a
part,
hog.
it does apply to both lessors and lessees, although the changes to lessors were minimal, primarily to make the lease accounting conform to, the new revenue standard, ASC 606. So it's really not going to change lessors all that much. Particularly recently, they came out with some, accounting standard updates to clarify and to modify the lessor impact to make it even less of an impact than some people were contemplating. So the short answer is yes, but it probably will not have that much of an impact for a lessor.
Okay, thanks, John. Are SaaS agreements such as QuickBooks considered leases?
The answer to that one is probably no. The standard requires that the subject asset has to be a specifically identifiable asset. I'm sorry, I got that backwards. I was looking at the rest of the question. For a QuickBooks Intact, software license, yes, it possibly could be considered a lease, depending upon whether or not you are just, licensing a specific copy or specific version of that software, its potential. It has to be a specifically identifiable asset, but it is possible that yes, a license to a copy to agree, license agreement for a software could be considered a lease. And on the
Okay.
second part of that question, if you don't mind me jumping in.
Sure.
What about an AOS agreement, Amazon Web Services agreement, where certain data is housed remote? Probably not, for the same reason that it has to be a specifically identified asset. So if you're housing data or running something or using Amazon Web Services, and you're just part of a bunch of other people who are using that same capacity, and you don't have your own dedicated server or your own dedicated region, then probably not. It probably would not qualify as a lease.
Okay. Here's another question. Do all payments made against the lease flow, do all the payments against the lease flow through the P&L as an expense?
Yes and no. Well, no, all payments don't flow. For an operating lease, the intent of the standard was not to make any changes to the P&L, which is one of the divergence between GAAP and IFRS. The standard for under the standard for an operating lease, the amount that gets flown through the P&L would be equal to what the normal lease payments would have been. So it's kind of a convoluted calculation, but you set up on the asset side the asset, and on the liability side you have the liability. You present value them, so you're figuring out the interest expense, and then you take, say the interest expense was 10,000 and the annual lease payments were 100,000. The amount that gets offset against the amortization to the asset is 90,000, so that the annual expense is a constant 100,000, the same as it would have been had it not been under this standard. On a finance lease, it works the same way it always did. You set the liability up at its present value, you recognize the interest expense, and then the principal payment on that liability goes against the liability, and then you amortize the asset the way that you always did. So there's not much change on a finance lease to the new standard.
Okay. Do these changes for leases mean I should purchase in the future rather than lease?
You know, I would say that it really shouldn't change your decision making. If you find that it's more financially beneficial for you to lease, that's not going to change. I wouldn't change the way I structure my deals just because of the accounting. You know, you have to look at the economic impact to your business and how you want to make those investments in property, plant, and equipment rather than make those decisions just based on the accounting rules.
Good answer. If I have a 10-year lease and a 5-year option, but I'm not sure if I'll exercise that option, do I use the 10 or 15-year for my calculation?
I think that depends upon how easy it is for you to not exercise the option. If you're in a location, or you have significant investments in capital equipment or other things that are going to make it prohibitive for you to move to a new location or not be economically advantageous, then I would say it's probably more likely that you're going to, or reasonably certain that you're going to renew the option. If that's not the case, if you can pick up and move fairly easily, without too much disruption to your business, then I would say use the 10.
I'm going to chime in here too. I think that this is another change in how the accounting is going to be done. I believe that as you go through that 10-year period, if there becomes a time when it's much more certain that you will extend, then I think you have to do the revaluation at that time. Under the old rules, you never really changed because you were just basically paying rent expense and expensing it on a straight line basis effectively. But now there are some times when you may need to remeasure based on the facts and circumstances at hand. So there's no one answer as to yes, it's 10, yes, it's 15. It may be that it starts out on a 10-year basis, And at some point in time with 2 or 3 years left, you have to remeasure it, and then maybe it goes for the next, if it's 2 years left, you'll base it on a 7-year period going forward until that final term ends.
Okay. Another question. What happens if a real estate lease from a related party, when the rate is updated yearly, but with no lease end, how do you determine the right of use value with it being open-ended?
Okay, I guess there's two parts to that question. I guess the first part, if the incremental, the amount that it's going to go up every single year is known, if you know it increases 2% every year or 3% every year, then you should factor that in. In terms of determining the right term, if it's a lease that is open-ended and doesn't have any termination date, then I think you have to go back to the actual property that's being leased, the assets being leased. If that's a property that's secured by a mortgage or something, and the only source of income for that property is, the operating entity, and maybe I'm getting off track here, but
And I think that one, John, that's a good answer. But you know what? That's the type of situation that's going to take a lot more consultation and evaluation and research. It's not something that, without knowing all the facts and circumstances, John mentioned there may be a mortgage, there may not be a mortgage. There's a lot of factors that would go into making the right determination in that situation, I think.
Got it. In general, why did the accounting lords just push this down? What good does it do to me as a business owner?
Well, most of us dealing with private companies in particular pretty much feel the same way. Now, when we go to SEC conferences, they all give the disclaimer that what I say is my own opinions and not the opinions of Stowe and Degon or anybody else. So I'm going to make that disclaimer right now. But the real impetus behind this was there was a movement, 10 years ago, to try and get the International Financial Reporting Standards, IFRS, in line with the United States generally accepted accounting practices, GAAP, and it never actually happened, but they went so far down this path trying to align US GAAP with IFRS relative to, it was primarily revenue and leases. And like John indicated, it didn't actually truly line up, but they went so far down the path that I think they felt there was a point of no return. I'm not sure if there'll be any amendments that make this easier to use. From time to time, the FASB, and it seems like there's a little bit more of a movement recently over the last several years to have big gap, little gap. So I wouldn't be surprised if down the road there's some more, amendments, practical expedience, exemptions for small companies with really basic leases. That's purely my opinion, but just based on recent history, they have exempted smaller businesses from some of the more onerous aspects of the recent pronouncements.
Great. If anybody else who's attending has any questions, if they could type them in here quickly. Otherwise, we're going to bring this program to a close. As we mentioned, we're going to have a second webinar, and John and Keith will present again. We'll do a deeper dive, and we'll go into more about the calculations and some of the more specific rules. And I suspect we can provide some typical footnote disclosure language and the like. So, John and Keith, any other final comment? Oh, here's another one. Will the asset and liabilities always be a one-to-one relationship to make sure the balance sheets remain in balance?
No. No.
Well, yeah, they're not always on a one-to, I mean, obviously the balance sheet will always be in balance, but for different reasons. There's different timing going through the P&L, so to speak. So in effect, obviously they have to be, it's hard to explain, but there are some timing differences. But obviously the difference between the two is what's going through the P&L. That's not just on a straight line basis.
Got it. So as I said, and we've stated before, we're going to have a second session, a deeper dive. And please look out for the invitation because that date has not been determined, but it'll probably be about a month from now. Keith and John, any other last minute comments?
I'm going to make one comment just related to one of the other questions regarding the software licensing. I think there may be potential in certain circumstances, but they would be rare. I really don't think typically that software licenses, being an intangible, are going to be in scope most times if you're just using them to as a pure subscription service. And you don't really own it or control it and have the ability to make changes to it. Other than that, I think, probably everybody understands that there could be a lot involved in this. I want to thank everybody that attended. It's great to see that this many people have, an interest in getting ahead of these things. And, hopefully, you'll contact us. We're here to help. And, that's the way we operate our firm is we're partners with our clients and we'll do everything within our power to address these things ahead of time so that none of us have any surprises. So thank you very much.
Great. Thanks, everybody. We'll see you in about another month. Take care.